stock indices and crypto are trading to the downside. Why is this happening? Let's unpack that in this week's weekly market update. Before we start though, as always, I need to stress that trading financial markets unfortunately is high risk and we may lose all of our invested money. As well, I will provide you my outlook on the markets, but this does not make it investment advice. Okay, good. So the market started to sell off last week because Trump announced a 25% tariffs on non-US made cars. So anything that's being imported to the US is going to be 25% more expensive starting from April 2nd. Now, what's interesting as well is that this is not only influencing German car makers, it's also influencing a lot of American car makers because they are producing cars in places like Mexico, but also in Canada. And they produce some elements of the car in the US, send it to Canada, then send it back. So there's a risk there that there is higher cost for the US consumer. And that's, of course, the reason why stock markets are trading to the downside. Crypto markets as well are following stock indices right now as people are so worried. What else? There might be more to tariffs starting from April 2nd. That's when we're going to have a Liberation Day. What does that mean? It means that if a country has a 10% tariffs on, say, imports of cars to their region, and the US has a lower tariff on the same sector, then the US will lift their tariffs so they match. The purpose, of course, is to get people to lower tariffs. Lower tariffs overall will make it cheaper for consumers worldwide. Now, the problem, though, is that Trump has mentioned the VAT is a barrier to trade. It's definitely a barrier to consumption because VAT makes things much more expensive. However, VAT, for example, in Europe and UK is applied to all goods. So it doesn't really matter if you're buying an iPhone or a Samsung phone. VAT is going to be the same across the board. So it's not hurting US products more than it's hurting anything else. And the problem is if they start to look at that, then tariffs are going to be quite high. Because if we look at this chart by the team at Capital Economics, find freely available online, you can see that they have here created this chart. So effectively, this graph shows you that India, in this case, they have additional tariffs on goods coming from the US to India that amount slightly more than 12%. And then you have Turkey, and then you have Brazil, and then you have Argentina. So all of these are emerging economies, which of course, if the US would hit them, so for example, if they would amp up their tariffs to match those 12%, then it's going to hurt the Indian economy. Now, what the US wants to do, it wants these countries to lower their barriers. Now, the reason why these countries usually have these barriers is because they are emerging economies and it's really difficult for them to compete in terms of quality and many times price compared with, say, US counterparts. So they have these tariffs to allow industries to build. Now, of course, if Trump gets his way, these are going to be lowered and it's going to be more accessible for the Indian consumer to buy from the US, which sometimes and many times is good. But in the long run, of course, it's always good to have some sort of industry. And that's the same reason why the US is trying to do this. For the markets that people actually trade, maybe the EURUSD and the GBP/USD and the dollar yen, there's not going to be too much of an impact here. You can see here that if you look at how this current setup is, the additional tariffs that they would need to introduce, say on EU on total value, is very low, so it shouldn't have a major impact. Of course, it will have sector impact. For example, up until recently, if you wanted to import an American car to the EU, you had to pay 10%. Whereas if you wanted to import a Porsche from Germany to the US, you would only pay 2.5%. But now with the auto tariffs kicking in, suddenly it's 25% if you want to sell something to the US and only 10% if you want to sell something to Europe. So if we just look at this, if we just focus and hone in on this specifically here, I don't really worry too much if this is what they're going to say. The problem is then what happens with the VAT. What if they suddenly say, oh no, VAT needs to be added there? Well, VAT, again, it's not discriminating against US goods. It's something that is impacting all goods. And that's when you have a problem. And that's why stock indices are moving to the downside. What else? What happened in the world last week? So last week we had the PMIs from the US. They actually ticked up a bit, a 3-month high. This is the composite combination of services and manufacturing. And you can see here that we went from 51.6 to 53.5. This is good because we had some bad data coming in, and this is obviously a worried market. But the way it looks like right now, it's looking okay. The way things are looking right now per these readings. And in the UK, it accelerated from 50.5, so barely growing, to growing at 52. That's a 6-month high. The gray chart here tells you it's the histogram and suggesting how much the GDP growth could be. Here's the euro area where we had pushed from 50.2, so barely growing, to 50.4, which is still barely growing. So this is neutral in a way for the euro, and this is bullish for the GBP, and this is actually bullish for the GBP, for the dollar. Now, what can we look forward to this week? Expect some volatility with the Aussie dollar rate meeting. They're probably going to leave rates unchanged at 4.1%, but at one point they will probably cut. Why do I say so? Because interest rates are 4.1, but their inflation rate is 2.4. If you take these two numbers on their own, there has to be more of a balance here, okay? This, if it would remain like this for a very long time, it would definitely weaken their economy. Now, why are they not rushing to cut rates? Because the unemployment rate remains at 4.1% and is stable around those levels. And then you have GDP growth, which is now a 1.7% annual growth, which is not bad and is picking up. So they could delay things slightly. We also look forward to euro area inflation, ISM manufacturing, ADP, unemployment claims, and services and NFPs. Let's break it down. Here's Eurozone inflation. So on this way up from 1.7% to 2.5, and then it dropped to 2.3. Tomorrow, these numbers are going to be out, and it's anticipated to be at 2.2. That will confirm that we had a very nice clear break here, and that will probably allow the euro area to cut interest rates. And that's really what the market is projecting. Another 25% basis point rate cut in April, which of course in the long run will fuel growth. In the case of the ADP, you definitely want to keep an eye on this. Marcus thinks we're going to jump from the low 77 figure to 118K. The PMIs, all of that tells us that's probably going to happen. But if for some reason there's a surprise and we're in a situation where we have another weak 77 reading or something like that, then that would obviously mark trend shift here, which would indicate that the US economy is not doing that good, and would indicate that maybe those PMIs that we talked about maybe just providing a false signal, even though I think it's quite unlikely. And for the non-farm payrolls, we had a reading of 151K last month, and people think it's gonna dip slightly lower. I wouldn't really trust so much for payrolls. It's very strong 1 month, weak the other one. Is pretty random. But of course, very low readings could spook the markets. And what I would focus on is really the unemployment rate, because it's different surveys. The one they ask companies, the other one they call people and ask them if they're working or not and if they're looking for work. And here the unemployment rate is anticipated to remain unchanged at 4.1, where it has been for quite a while. So from a trading perspective, what are we looking at? You have your EURUSD, which bottomed out from that 200-day moving average and is pushing a little bit to the upside, because what we have seen is that tariffs is to some extent hurting the US economy, and it's also hurting the dollar. And technically, we were very bullish here. This is on the back of the infrastructure deal we saw in Germany. That was voted through, and that's supposed to lead to higher economic growth. And we pushed a little bit lower here. I would argue trading sideways between these two with a bullish bias. The RSI as well bottomed out from the 50 levels, so could probably push upwards. Here are gold prices. Definitely want to focus on this. So with the uncertainty in the world, stock market's lower, crypto lower, tariffs, potential inflation down the line, people are quite bullish on gold prices, where I was bullish as well. I did think that we were going to have a bit of a dip. I thought we were going to have more of a dip before heading to the upside. Instead, we pushed substantially higher. And again, we need to wait for a dip. If you look here, RSI is overbought, and then here, and then there's a higher RSI over here. So we have a divergence to some extent in the RSI, telling us that a high could soon come in play. But we don't want to be betting on that slide. If you know what you're doing, you want to short a little bit, of course it's possible. But the preference would be buy dips at these two levels and being bullish above $3,000 per ounce. Here's Brent crude oil prices. So last week we said we're probably going to go down a little bit and then push up. It pushed up and reached the sort of sell levels here. 200-day moving average is now meeting up with price. These support levels now turn into resistance alongside with this high here. And I think between 73K and 74.7K, people are going to be selling. So take it down to 71, maybe 70, and then we'll see what happens. In the case of the Nasdaq 100, so the Nasdaq 100 touched this 200-day moving average, and we talked about these levels being really important, and the price did limit there, and then we traded to the downside. Of course, I thought we were gonna go down here and then maybe bounce, okay? I didn't really anticipate these auto tariffs kicking in, and that happened, of course. So when things happen, you need to take that into account and adjust your view on things and not buy the dip. So not buying the dip here would have saved you a bit, and if it didn't, small loss, that's all right. Before that, we had been saying that we could be bullish from these levels pushing up. Looking at this today, now of course, Trump will usually, talk very aggressively and then cut a deal. We know, we've seen it before. Bit of luck, we get some sort of a deal quite quickly, although it seems quite unlikely right now, but it could happen. We do know with the tariffs they put on China, they're still in play, okay? The tariffs they put on Mexico and Canada, they have been watered down, so it's not covering as much. But in total, in terms of tariffs, he has increased them substantially more than he did the first time he was a president. And this could potentially lead to weakening an economy. And we'll see what happens. I think realistically, if they would raise tariffs on some of these smaller emerging countries, they would remain in play. I don't really see how they have to please these countries. Worse in the case of Canada, Mexico, they're quite happy to be flexible. Long story short, for now, bearish below 20K, okay? Bearish below that level. If we would go up to say 19,600, I think people are gonna short sell and then target 19,138, 18,585, and then maybe 18,317, which is also low, should be the low for September of last year. In the case of Bitcoin, so we talked about this trend line here, which you can't see right now because it's been removed. I said we could break it, but that might not necessarily mean the beginning of a push to the upside. I've been saying just relax a bit. And surely we had a lower high here. This is good. This is good because whenever we break this, we'll break that trend line, which you can't see, but you can imagine, and break above here and then probably down and then probably upwards. We are still above the 200 moving average. Now the big problem here is, of course, what's happening with indices. If indices drop another 5-10% to the downside, then this is going to be down closer to sort of $62-$65 per coin. Now, why is this not as bearish as everything else? I would argue just because we have that potential deal coming up for cryptocurrencies. If they deregulate, if it did make it easier to raise money and capital via crypto markets, then it's going to be really good for the economy, and it's obviously be very good for cryptos in general. But right now, people are worried. Data coming out is okay, but not as good, and people are worrying about the future, and that is why this continues to be bearish. And realistically, if it would go up a little bit, I think people are going to sell, target 76, and then we'll see what's going to happen next. But if someone said, Alex, you need to choose, you want to short indices or you want to short crypto, then I would say let's short indices. I think that's where most of the value is. With that in mind, we're going to wrap things up. I hope you have a great week ahead, and I'll see you next week. If you have any comments, drop them below. Thank you.